G'day everyone, it's Michael here from Risk Biscuits. Thanks for joining us once again. Today we've got a very special guest, interesting story, very interesting background, but probably one of the fellows you'll meet around. As always, this show, just to give you some backgrounds, just sort of myself talking about markets and talking to other traders. We're not experts, we're just sort of ordinary people participating and having a go in the market. If you enjoy the show, please like and subscribe. I keep forgetting I'm a YouTuber now, so I've got to say that. And today I'd like to welcome our not our first guest, my third guest, Scott Phillips. G'day, Scott. How are you?
I'm great, Michael. Good to meet you. And it's cool. We've been interacting for a while online and we're kind of mates, and I like that.
Yeah, it's great. And it's great to sort of meet you in person see you in person and have a bit of a chat. So I really appreciate you coming on the show. Before I started, I might just put something up just to cover all our bases. Just a bit of a disclaimer. This is probably a good sort of understanding of sort of who I am and who Scott is in the market. Look, this is just a general discussion, not intended to be financial advice. If you'd like financial advice, go somewhere else and seek it. It's just two mates having a beer and having a chat. So anyway, without further ado, let's get into the show. So, Scott, maybe I'll start with what I think I know about you, and then we can kind of go from there. So, you're obviously a trader. I think you're sort of a trend follower. Is sort of your spot in the market. Private sort of retail trader, doing your own thing for a period of time. Is that sort of generally correct and fair?
That's generally correct and fair, but with some wrinkles. I didn't start out that way. I started out, technical analysis adjacent kind of bullshit. It doesn't work actually, and then I tried to build trading systems, and because I'm kind of a street smart hustler kind of guy, I thought I'm definitely not going to get ripped off by all these obvious fraudy trading educator types. And so I picked two trading educators that I paid vast sums of money to teach me, and they turned out to be the worst grifters of all. They were two guys in that original Market Wizards book, Van Tharp, who's like supposedly the guy when it comes to trading systems, and Ed Sekoda, who was one of the original trend followers, and both of them were just like so fucking weird and grifty and like complete frauds, 100% fraud, start to finish.
Right.
Yeah, and so I paid them money to learn off them, and then the beautiful thing about trading trends is that trends exist irregardless of how shit you are at trading. So if your sort of North Star is I'm going to trade in the direction of the trend, then even if you've got a crappy system, as long as it's anything even remotely systematic, you're actually kind of okay. Like, within boundaries, like as long as you're not doing like completely stupid things. So
yeah, okay. So let's maybe take a step back a little bit. So where did your interest in trading come from, and how did it all start?
My mum did a weird midlife career. My mum was like a private investor, entrepreneurial type who loved her own investing back in the 80s when I was growing up, when it was still possible, when there was alpha in stock picking, right? Like there's not anymore.
Okay. Yep.
And our conversations around the dinner table at night were around like, which stock are we putting the family portfolio in? So I kind of grew up around that. And I remember that, the first finance book I read was George Soros's Alchemy of Finance when I was like 12. And they used to have this stock market gain thing in the newspaper every week in the 80s in Brisbane, and you could write in a stock portfolio and they'd track it for you. And I was interested in it from a young age, and I became a criminal. I was a drug dealer and a drug addict and all kinds of crime, actually, like pretty much any sort of crime you could imagine I did. And I was always jealous of my sisters who could answer this. My sisters are doctors and they could answer this question, what do you do? And I remember once I was in this fucking lunch with John Howard when he was Prime Minister at the time, I thought I got invited to a lunch. I was bribing some Liberal Party politician, and they said, "Oh, why don't you come to lunch with John Howard?" I said, "Yeah, whatever." And I thought it'd be me in a room with 100 people. It's like me in a room with the PM and 5 people, and he's going around the thing like asking, "Oh, what do you do?" And I'm thinking, "What the fuck do I say?" Like, "Oh, I sell porn, a little bit of this, a little bit of credit card fraud on the side. I do some loan sharking too." And I was always really jealous of people who could answer that question. And my best mate was a really high integrity sort of guy. He was a stockbroker. And I'd always admired him, and he'd supported himself as an independent stock trader, which I now know is almost impossible. Like you have to actually be really good, but he was really good. He was the 3rd generation stockbroker, and I went to jail for quite a while, for kidnapping and torturing some of my enemies, which was just unlucky for them. And then while I was in jail, I thought I'd re-educate myself and straighten up and fly right and get a career. And I was going to become an independent trader. And while I was in jail, I read like every fucking written word on every book you could possibly imagine. I had them all sent in every day. And I used to hand draw charts. Like I'd phone out to my girlfriend and get the open, high, low close prices from the spoos, and I'd hand draw charts, and before I went in, I paid some grifter to teach me price action stuff, which was surprisingly not bad. And I hand drew charts while I was in jail, and I got out and I couldn't wait to get into trading, and I'm like, well, first of all, I had to commit a few more crimes to get enough money to start trading, because I walked out of jail with like nothing, with all my possessions in a shoebox, and this was tremendously humiliating for me, right? Because I was a successful criminal, and I was relatively famous, and I was the sort of guy who'd get on the front page of the paper all the time for doing dumb shit. And so losing everything, coming out of jail with nothing, and then having to start again, this was, I just naturally assumed I'd be successful, and I wasn't. I blew up that first account. And then I committed some more crimes, and then funded another account and blew that one up, and I started funding smaller accounts then, and eventually, I got it together, and had some good luck. Had good luck and poor risk management when I didn't understand what risk management was, and I turned my little grub stake into something, and I'd realized that I couldn't be a discretionary trader. Like, I just don't like the idea that I'm going to like be Ray Dalio and like, I think interest rates are going to go here, and I think this is going to happen with the global economy, and we're going to be in recession on that date. Like, I tried that, and I'm not smart enough, or it's not possible, but I know there's people who are good enough to do that, but I'm just not one of them. So
yeah, okay.
Yeah.
So all right, so that's a pretty amazing, sort of story. That's not the thing that you sort of hear every day. So you're in prison, you've, I guess, kind of self-taught yourself, read all the books, and I guess got serious at it, and then you've come out and you've sort of had a bit of a crack and
had a bit of a crack and lost, and then I had a little bit of success. I resurrected one of my old mentor's systems, and I started trading that with poor risk management, but I doubled my money in like 6 months. I was like, okay, well, discretionary punting, I lost money, and I doubled my account. And I doubled my account this way. So maybe I should find the best trading system designer mentors that I could. And foolishly me, I read the Market Wizard books, and it talks about this guy, Van Tharp, who's like the guy in trading systems. And I went and paid him a bunch of money to teach me complete nonsense. Like, if trading systems were his ass, he couldn't find them with both hands. Like, fuck that guy. and then through him, I got introduced to this guy, Ed Sakota, who was one of the original 1970s trend followers. Made a big dollar because trend following was super easy then. It like worked 5 times as well as it does today. And so he was rich, and he ran this kind of cult. It was free, and then he used to have like a 1-900 phones, like a phone sex line where you paid by the minute to talk to him and ask him for advice about trading systems. And this fucking prick, he would not be drawn. about any sort of objective rules about trading systems. You say, oh, do you like gold? And he'd be like, oh, it's shiny and it makes nice jewelry. And like, do you think that you'd say, well, how do you define a trend? And his answer would be something like, oh, well, draw it on a big piece of paper and put it on the back wall and go to the up as far away as you can. And if it looks like it starts at the bottom left and goes to the top right, it's probably a trend. I was like,
Yeah.
you just couldn't get a straight answer out of this guy about what trading systems were. And, you know, eventually all the people who were dealing with him reverse engineered his trading systems. And so anyway, I figured out what a number of us thought was his trading system. And I took that, and his trading system was retarded. Like all the early trend following systems are so retarded. They're literally, if take a list of markets, and if anything closes above the 50-day high, buy it. That's it. With a stop like 4 ATRs away or something like that, between 4 and 5 ATRs.
Yeah. Okay.
And they would trade those on a big universe of markets. And so I started doing that. And in 2014, I did really well out of that. The risk management was all wrong, and it's very problematical as an independent trader to trade TradFi futures trend, because you pay margin on each contract, and it works better the more markets you have. Like trend following scales, trend following Sharpe ratio scales independently with the square root of the number of independent bets. So 40 markets is much better than 10 markets, like much better.
Yep.
And unlike other types of trading, that scale almost has no end. Like it's got a diminishing return because of the nature of square root of the number of bets. But if you keep adding markets, you can keep adding Sharpe ratio to your system, which is what the good trend followers do now, is they just keep adding hundreds and hundreds and hundreds of weird markets.
Yeah. Okay. So for someone like me, like I sort of know roughly what trend following is, but I don't really, I don't practice it. So just kind of expand a bit in terms of like today, not, the charlatans of the past, but today, what are you doing that's a trend follower, and how are they kind of approaching the market, if that makes sense?
Sure. So trend following is the idea that you're going to buy the thing, you're going to take a large universe of whatever. I do it on TradFi and I do it on crypto, which works much better, because everything works better on crypto because it's riskier. And you're going to take, essentially, you're buying things that are going up. If anything's going up, you're buying it. If anything's going down, you're shorting it. And why does this work? There's behavioral reasons, like, the way that for example, what's a recent example? Like when that Ozempic drug maker came out, it was obvious that was a game-changing drug. The stock should be higher, right? But the human brain can't really comprehend how much of a game changer certain things are. Like when Apple released the iPhone, like the human brain can't really comprehend that that's like the biggest deal in a long time for Apple. Their stock jumps 20 or 30% off the bat, but it's got thousands of percent still to go to reach fair value. And
Yep.
And at the other end of that, we get an overreaction at the end when everyone sees that money is easy to be made, like, for example, property in Australia, or, for example, crypto in 2021. People pile into that, and that creates an exhaustion of buyers and pushes price far past their fair value, and that sets up the reverse trend. And this works much better on commodities and well, not just on commodities, but it works better on futures markets than equities. You wouldn't trade if you're going to trade equities. There's much better ways to do it than trend following.
Okay, so you're essentially you're trying to find something that's going up or down, and you're using futures, and there's as many markets as possible to improve your Sharpe ratio. So you just
the Sharpe ratio on any individual instrument in the long term will probably only be a Sharpe ratio of 0.2. Like really, like people say, oh, I do trend following on the SPOOs. It's like your Sharpe ratio is 0.2, motherfucker. Like that's not, you shouldn't be bragging about that. But if you take 0.2 there and 0.2 on crude and 0.2 on gold and 0.2 on this, and you get enough of them together, and they scale with and the Sharpe scales with the square root of the number of independent bets, then you've got something. So there's two types of trend following systems. The original old school ones were firstly from Coda, and there was a couple of other like guys who were talking to each other. The guy Richard Donchian, who invented the Donchian channel in the fax machine days, he was keen to get all these old school trend followers using his thing. So he used to fax them out information about Donchian channels, and they all Donchian channels are breakouts. And so all these old school systems are about, you buy say a 50-day breakout, or the Turtle system was a 20-day breakout, and they're going to choose a risk, and the risk will be like that. How much are we risking per trade? Sort of concept. You familiar with that?
Yep.
Yeah. So we're risking 1% of our account per trade, or so a typical old school trend following system, because they're taking 30 or 40 positions at a time, will risk about 10 to 19 basis points per trade. There's a problem with that, in that as soon as you get in a trade and the trend starts to go, typically volatility, it doesn't have to, but typically volatility will spike. So at some point you're holding these giant positions, which are like way bigger than you should, and then you get way bigger equity swings than you should. So the more modern way of doing it is kind of like, the quantity way is to say, well, how strong do we think the trend is? If we think the trend is like just getting started, we'll take a small position. If we think the trend is ball strong, we'll take a big position. And then the other element to it is, what is your estimate of volatility going to be? And we're going to resize our position every single day based on how strong we think the trend is, and how strong we think volatility is. And that's the mathematically correct way to do it. And we know that's true because that's the way that all the real quant firms do it. Because if you look at trend followers, like, you're probably not in the trend following world, but most of the big name trend followers who've been around for a long time are complete fucking retards. Like, they like it's absolute midwit town. Which is why I chose it, because I'm not smart enough to compete with, like, I can't compete with some of the guys that we hang out with on Twitter, right? Like, in a battle of wits against them, like, what am I going to do, right? So trend is really beautiful because it's a left curve thing, right? The dumbasses who are just Bitcoin's going to $1 million a Bitcoin, and I'm left curving it. I'm fucking Bitcoin's going to. He's got the same trade on as me right now, right? Like, I've got this proper quant sort of thing, and I'm doing exactly the same thing as the dumb motherfucker who's like laser eyes by Bitcoin.
Yeah.
So trend is a game that a normal guy like me can reasonably compete with. And one of the big problems you have with other quant systems is, if you're looking at generating alpha, someone else can steal your alpha. Like it may not last forever. Your system can stop working. Like, the beautiful thing about trend is a very weak edge. It's almost the weakest edge that's still an edge.
Yeah. And in some ways it kind of exists because it's so weak that most
exactly
people aren't.
So.
Yeah.
It's analogous to, it's opposite, but analogous to like value investing for stocks. Like we all know value investing stocks works, but if your car worked that way, you'd shoot the mechanic, right? Like, it's got, like, Buffett has a 15-year drawdown. Like what retail investors can put up with a 15-year drawdown and keep swinging the bat, right? Like trend has a true Sharpe ratio of, depending on how you do it, somewhere between 0.7 and 1-ish. And you can juice it to 1.3 to 1.6, or maybe a bit higher on crypto, right? I mean, a Sharpe ratio of 0.7 implies that you're going to have, if you trade it for 100 years, you're going to have decade-long drawdowns. That's just what it implies.
Yeah. Okay. Interesting. All right. So, you've got this trend system in place. You're presumably trading as many markets as possible, both in traditional finance and in crypto.
Well, I gave up TradFi trend in 2019 to start. I completely pivoted to crypto. So
yeah. So why is that? What's more attractive about crypto?
Okay, so that's kind of the bottom line is that on average, buy and hold stocks pays more than leave your money in the bank, right? Like, on average.
Yep.
And that's because companies are riskier than banks, right?
Yep.
Like, so a rational investor would want more money in return. So what we see universally, if you look at any of, and if we look at the things that are an edge in finance, like there's only like half a dozen real edges, right? Like, selling vol, buying and hold stocks, value, carry, trend. There's a few more, but there's only
realistically, we try and make it fancy, but there's only so many ways you can skin a cat.
Exactly. So, and what we see when you test anything at all, whether it's from buy and hold, carry, cross-sectional carry, time series carry, cross-sectional momentum, any fucking thing that you want, even market making is both easier and more profitable on crypto because crypto has higher risk. Like there's crazy counterparty risk. Like you can, and I did get FTX'd. So, a rational investor would want to be compensated for that. So, for example, my crypto trend hasn't done particularly well in the last year for crypto, but on the last year, it's still a real world sharp 1.73.
Okay, that's pretty good.
It's not bad. Like for the worst time that crypto's ever had in trend, right?
Still that's not bad at all. You would take that any day of the week.
Yeah. So a crypto trend has some other advantages for the retail investors. So if I want to trade 40 markets in TradFi, I need to be trading probably a 700 grand account to do that. Just to cover the margin and leave a margin for error.
Yep.
I can trade, 100 crypto instruments with probably 4 grand, maybe 5 grand makes it easy.
Yeah. Okay. Yeah. Because it's much smaller size and you can fractions of a coin and what sort of
fractions of a coin and a minimum position size is $10 and not a crude oil contract is 100 barrels of oil, there's 100 grand and blah, blah, blah.
Yeah. Okay. All right. Yeah. And that makes sense. I mean, the way that I think about crypto, like obviously, it's not really it's not a space that I play in at all, I've dabbled in it, but it's not really a thing. But, obviously yourself and various others who are sort of pretty good at this game play in the space because the returns are good as it's an underdeveloped market. It's unregulated. It's more inefficient.
I think that's the heart of it is that it's more inefficient, like, especially the way the liquidity cascades out, like, and it changes so fast. So Binance is all the liquidity, and then the prices are really set in Binance and they flow out from there.
Yeah.
And so these markets are very inefficient. So if you go and buy, I accidentally hit a market order on some shit coin the other day for 2.5 grand, and I spiked the price like 30%. Like that's how thin some of those markets are. So you can really push crypto markets around pretty easily, which means that they're much more inefficient. There's much more everything that you could possibly do in traditional finance, which is highly competitive, is much easier, much lower bar to success. It won't always be that way, but it's a much lower bar to success, right?
Yeah, so it's probably the equivalent of say trend following in the 1950s in TradFi.
Exactly.
Which has just become so much more efficient and fast and that sort of thing over time.
Well, if you think about the original trend followers, the guys starting in the 70s, most of the financial futures contracts only started trading in the 70s. So they couldn't do a backtest. Like if someone said to you, in 1980, we've got this trend following thing, it's printing money, and you say, okay, you can't do a backtest. Why does it work? No one knows. There was none of the academic papers were done on it. Like the seminal academic paper on momentum was Jagadish and Titman in 1993. This is like decades before academics discovered it. These guys were like punting, like punting work. So you can understand why there was higher returns back then. It's not necessarily because the edge was eroded. It's just because there was more risk in the whole concept. And the edge in TradFi, I still have some money in TradFi Trend. In 2019, I dumped my TradFi Trend into a fund, which has done much better than I ever did with it.
Okay, good for you.
Yeah, well, it's just pure luck because I wanted to pivot to crypto and I needed to develop these crypto trading systems, and it was like it was a big job, and I just couldn't be waking up every day at 4:40 in the morning here in Thailand to place my orders. So I grudgingly gave up my TradFi trend, which turns out to have been really good. Like, and everyone should do that, right? Like, if you're a retail investor and you're thinking about doing trend, probably just shove your money in a trend following fund. Is pick a good one, and we'll pick a couple of them, and that's probably you'd have to be lucky to beat them, really.
Yeah. I think, like ultimately the lesson for the vast majority of people is let somebody else do it for you, unless you've got a burning desire and a real passion for it. Yeah.
That's exactly it. And unless you feel it in your bones that this is your calling, which I kind of do.
Yep. Yeah, cool.
You shouldn't be doing this. You absolutely shouldn't be trading as a retail trader.
Yeah, absolutely fair. Okay, so all right. So in terms of, I guess, how you look at the market and look at investments, so is it just like you don't care at all in terms of what you're trading? A signal hits based on whatever your framework is, and you're buying it or selling.
So I also have a what I call a cracker account, which is I keep a couple of small accounts just for punting, which satisfies that like nasty part of my soul that just wants to come up with an idea and punt on things. Without that, and actually Sakota taught me that, without that safety valve, I find it very, very difficult to trade systematically. Like even if it's just a small account where you can do what you want, like with no, so I do a little bit. I do a little bit of shitcoin punting.
Yeah, I do the same thing. Like I have a trade that I do on Mondays, and I mean it works. And I didn't come up with it, but it's it's small, but on one level, it just sort of satisfies that desire to do a trade and to do something, whereas the bulk of my money is just sitting in systematic and reading on a quarterly basis.
So it should. I mean, that's a very smart way to do things, man.
Yeah, but you've got to satisfy that urge, because otherwise you just trade the real stuff, and
it just comes out sideways for me. I just find myself behaving like a massive cock in the markets and beyond a certain point, you're trading enough money that you can really do yourself damage. Like you can lose money that I don't really want to lose.
Yeah, absolutely. It can certainly get the best of you. That's for sure. Okay, so signals hit, buy whatever, you're just processing the order pretty much.
Well, it's all automated now, so
yeah, okay.
Yeah.
So everything's 100% sort of systematic. There's no kind of just
no,
just relying on the model.
Yeah, just relying on the model. I mean, I do have some discretionary shitcoin punting that I do, and but mostly, that's a rounding error on my yearly P&L, right?
Yeah. Okay. Yep. Cool. Okay. So this is probably more of a sort of an essay question, given you're so sort of systematic. But if I guess in terms of an investment, when you sort of boil it all down, and you were sort of saying earlier, like try and make this very complicated, but there's really only sort of 5 or 6 different ways to do things.
Mm-hmm.
So boil it down and you look at an investment, like what do you think the real driver of, like what's the ultimate driver of an investment's success? Like what's the real driver of returns underneath all of the sort of fancy and complex
strip all the bullshit out of it.
Yeah.
Caveman Michael sitting around a campfire 100,000 years ago, he breaks his leg. He breaks his leg, you're probably going to die. So we are, as a species, DNA, we are very risk averse. So what we see universally is that risky things tend to be underpriced, because you wouldn't invest in shitcoins because most of them are scams, and you're probably going to lose all your money, right?
Yep.
So at a deep level, those things tend to be, on average, not every time, very underpriced, because the more sensible you are, the more you're not going to do anything stupidly risky, right? And we have that tendency. So that's, to me, that's the driver underlying everything. But I have no confidence in my ability to pick market direction, but with one exception. So what I kind of believe is that, if you had have nailed the big macro theme of the last decade, which was the Fed had PTSD from 2008, and they were absolutely determined that that was never going to happen again, and they were going to juice the markets with a margin of safety just to make sure of it because of that. And also that before that, investors had PTSD from the tech wreck, and the tech stocks were fundamentally undervalued because people hated them after 2001. If you had have picked that and dumped into tech stocks at the end of the GFC, that was the trade of your life. Like that's a sharp three strategy for a decade. No one could touch you. The best traders in the world couldn't have done as well as that, right? The best active traders.
Yep. Absolutely.
So in a general sense, I like to I call it buy them when they hate them and sell them when they love them. And so I like to get involved in crypto right when everyone fucking hates crypto. And I like to switch the machines off right when your mates are calling you saying, "Yo, have you heard about this XRP coin? I hear it's going to be the future of money." You know, as soon as you start getting those calls, it's like, okay, now we're fucked.
Yeah.
So that's the only kind of macro adjacent kind of thing that I would ever do is notice when, like, you know, like property in Australia, like, you know, the structural reasons why it's probably going to keep going, but you know, buy it when they hate it and sell it when they love it. Like it's pretty obvious that trend is going to just keep going until it's forced to stop, right?
Yeah, like I think the Australian property thing's this weird structural bubble that everyone, you know, like on any kind of fundamental basis, there's a problem. But sort of culturally, spiritually, even we're just, you know, like Australians think of property the way, yeah, like we, you know, it's like no one owns. I mean, people own shares in Australia, but people own property. You know, like everyone owns property in Australia or wants
doubles
to own
every
property.
10 years, mate.
Yeah, exactly. Yeah, I mean, why wouldn't you? It doubles every 10 years. And you know, the government's behind it. So, you know, eventually that will run until
it's forced to stop. Until it's forced.
Yeah.
You know, and Soros has a really good theory. Soros's book really explains the dynamics of that. If someone wants to understand like that stuff, that book is probably the best treatment of it. His idea was you find a market that is in equilibrium for a long time that's done nothing, and then you look for he's looking for two changes in the input. So we had the changes in the changes in tax treatment of principal place of residence and negative gearing. Well, negative gearing wasn't there, but the tax treatment and the lowering of interest rates together ignited the property boom, and then that created a wave which is now carrying on, and it just got into its, you know, lunatic phase in the last couple of years, and you know it's still going, right? Like property's still going up in Australia for sure.
Yeah, it is. It doesn't seem to ever end.
But it's definitely, if you are, you know, 0 to midnight, you know, we're 11:30 and people are turning into pumpkins at some point in the future, right?
Yeah, I think so. Like if I think about my own kind of investing career, probably the biggest mistake I've made and is that I didn't take on enough leverage and buy enough Australian property.
Same. And I had plenty of Australian property and I sold most of it. I've still got some, but yeah, this is like that was probably, not understanding that is probably my biggest investing regret.
Yeah, I think so. Either that or, you know, catching all the fangs and just hanging on to them for 10, 15 years where I want to, but you know, hindsight's always 2020. All right, so you know, although you sort of one thing I wanted to ask just around sort of portfolio construction. So
Sure.
whether it's TradFi or crypto, how are you kind of think that in terms of like managing risk and that sort of thing?
Sure, that's there's only one thing that you want to know, which is if you're looking at how much do I like my trading system, it's really the question of, is what's inside the box, does that match what I expected on the label? You know, I expected this, did I get that? And so what you want to really know is how much do I want my account to wiggle? Do I want it to do that? Or do I want it to do this? And so you want to set a volatility target for your own account. So for example, a normal, you know, commercial hedge fund would probably be, I don't know, somewhere somewhere between 6 and 11% volatility. I run my own personal accounts between 35 and 45% volatility because I'm an ex-drug addict and ex-criminal, and I'm comfortable with risk, and like fuck it, we ball. So you want to size your positions such that in aggregate, all of your positions together should wiggle the amount that you want them to wiggle. And that's a personal choice. And it's not about how much money am I going to make. It's about how much of my position is going to wiggle. Because your returns in any trading system are highly uncertain. Like a Sharpe ratio of 1 implies that you could go 5 years losing money, right? And a Sharpe ratio of 1 is better than 95% of hedge funds. Like you'd be fucking stoked as an individual investor to have a Sharpe ratio of 1 in the long term.
Yeah.
But,
yeah, that's fair comment. Yep.
But you could easily lose 5 years in a row.
Yeah, and it's hard as a retail investor to stay the course. By year 3 or 4, most people are looking for something else.
So I had a 4-year drawdown in trend, and pulling out of it was one of the I think I might have the back test.
Yeah, put it up if you got it.
Yeah, let me see if I can find it. Hold on one sec. Yeah, here we go. Can you enable screen sharing for a second?
Yeah, just let me figure out how to do that. Oh yeah.
Got it?
Does that work?
Yeah, there we go. So these are the backtest results looking fucking crazy good. And so I thought, fuck it, I'm going to ball with that. And then this was the real results.
Okay.
Yeah.
Okay, so on the left is your back test, and then on the right is the actual outcome.
Yeah. And this is 4 years.
Yeah, okay, and that's hard because it's like
it's hard. It's brutal.
It's not like a big drawdown in year 1 and then a slow recovery.
It just bleeds you. Well, let me show you. Let me show you my current system results, and you'll see that this is a characteristic of trend.
So why does the back test? I mean, we all know that back tests aren't.
It wasn't a particularly rigorous process of mine. So that was me.
Yeah. Okay.
7 or 8 years ago, really barely knowing what I'm doing. This is more of a properly constructed trend following system, and you can see the big difference is that we don't have the wild swings because we're using volatility targeting. We're not accepting random exposures. So what happens when you put on a trade is you put on a trade, and then the market messes with you and then changes your exposures. Like all of a sudden you've got more risk on, or a successful long grows, a successful short shrinks. So if you've got a short and it's winning money, your short is shrinking in size, and so a proper portfolio construction will adjust your positions for the amount of risk that you want. And you can see that trend has this natural characteristic of it goes sideways for a long time, does nothing, like absolutely nothing, then prints it, then goes sideways, then prints it, and it goes sideways for long periods of time. This is a characteristic of trend. All of what we call I'm assuming you know, like James's definition of risk premia and
yeah.
Do you want me just to explain that briefly for a sec?
Yeah, step everyone through it just in case people don't know.
So this is from Ewan, who gave it to James, who gave it to us. By the way, the robot James, probably the best, nicest guy trader that I know. He's taught me like 90. If any of this sounds like I know what I'm talking about, mostly I'm probably just regurgitating James's stuff. There's two and only two ways you can make money out of markets. The first way is by identifying and mispricing. The market's got it wrong. The available liquidity has been overwhelmed. You notice it, but that's a very attractive opportunity, very high Sharpe ratio opportunities. What's attractive to you is attractive to someone else.
Yeah.
So it's very competitive. The other thing is what's called risk premium, just taking on risk that other people don't want. Why wouldn't someone want to take on a certain type of risk? Well, because that type of risk must suck. Like there's something inherently sucky about, my real world trend following results that I showed you, which is objectively an edge, but you can go through 4 years of getting fucked. Or this, where you can just sit and do nothing for ages and ages and ages. And then, we've been printing it the last, because crypto starts trending and we're starting to trending. But if I look at my longest drawdown, you can have even with crypto trend, you can have a 300 and, a year-long drawdown.
Yeah, okay. Still, those numbers are pretty good, mate. Like,
it's a good system, dude. It's a really good system. It's like, these are the monthly returns. It's pretty good. These are the drawdowns. So it's
okay.
good. But that's so everything that's a risk premium has some aspect of sucking to it. Like if you look at the other risk premium, like just buying and holding equities is risk premium, but equities make money most years, but shit the bed every 10 years, right? Same with carry. In 2008, the AED JPY carry trade gave up 5 years of gains in 6 weeks. Like it's just nothing for nothing. Like there's nothing for free. So you get this devil deal in risk premium systems between negative skew ones that make money most of the time and then shit the bed, like selling, like you've done some vol selling, right?
Yep. Yeah. So vol's like that. Yeah. Makes a little bit of money most days and then it just shits itself.
And then you grind it back out, right? So trend is the opposite of that. Trend is you lose money most days. You don't even make money. You lose money most days. TradFi trend, when I did it, I worked out that I was in drawdown on average 9.5 months of every year.
Yeah, okay. Wow.
It's really like that. So you get paid, you don't, but you get the thing that you have to frame is that you get paid for that. You don't get paid in spite of that. The only reason everyone's not trading trend, because everyone in the world knows that trend's an edge. The only reason everyone hasn't piled into it is because it sucks so bad to do. It sucks as a trend trader. Trend absolutely sucks, and you shouldn't do it. Like it's my honest, like emotionally, so hard on the emotions.
Yeah, I was going to say, like emotionally and mentally, that would be really
dude, you have to
challenging.
Be
so how do you deal with that? Like if you're having a 9-10 month.
It's a reframe. Most traders have a lot of things to worry about. You have to worry about the Fed. You have to worry about all this. You have to worry about all these things. Trend trader only has one thing to worry about: is following the system. You don't need to know any macroeconomics. You can be dumb as a bucket of hair. You don't need to do anything because you absolutely know that in the long run, because it sucks so much, it's fundamentally underpriced.
Yeah.
And eventually your day will come. And so the reframe that you do in your head is that we have this idea that if you've got a drawdown in your equities portfolio, it's because you're an idiot. You picked the wrong stock. You hit the red, get ahead, hit the black, set you back. You're a dumbass. You're paying a penalty. You're paying a fine. You're paying a drawdown. I'm taking your money because you're so stupid and you picked the wrong stock, right? Like that's fundamentally the way that most people kind of think about it. In trend, you have to think about it. You're buying a ticket on a ride. Yeah. Ride might be up, ride might be down. Like let's fucking find out. You're buying a ticket to a concert. Maybe it's a good concert or a bad concert. Let's go. And you just, in a very real sense, if you look at the correlation of trend returns to market volatility, that it's strongly, trend does well in times of volatility. So you're essentially monetizing. You're essentially long vol.
Yeah, I was just going to say,
but in a way that makes sense. Not tail vol selling, tail buying, like monetizing vol that way is a much harder and much higher skill thing to do. Yeah. And trend actually makes like tail hedging. They make money like one month out of every 10 years, right?
Yeah, it just feels like a mind fuck, to be honest. Like just the guys that are like the tail hedgers and that sort of thing. Like and don't get me wrong, like a lot of them are
super smart.
All of them are very smart compared to me.
You can't play against those guys.
No idea. Yeah, okay, but you can play a similar game via trend, is what you're saying.
You can play a game that's like a lower degree of difficulty game, and trend still makes money when equities goes up. But the other good, if you're doing TradFi trend, the beautiful property of trend following is that if the world shits the bed, what's going to happen? Like if we get a COVID-20 war between China, I did so well in the Ukraine war, and COVID was like, it's just unbelievable how well trend does when the world blows up. So it lets you be this kind of closet bear tart without being one of those idiots that are always drawing lines on charts going, oh, it's about to crash. It's about to crash. You fucking idiot. It's never going to crash. Equities go up. Stocks go up. Fucking grow up.
Yeah, okay. So talk to me about so why does it do so well through like COVID or
Okay. So let's imagine. Let me share my screen again. So let's look at let's look at this. Let's look at the SPOOs. And so if we're talking about a typical trend signal, the industry standard for trend is moving average crossovers, which sounds dumb because they're like, the basic bitch of technical analysis, or breakouts. So let's put up a Donshin channel, whatever the defaults are, that'll be fine. So it's mechanically long from here. Long, 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 long. Mechanically short from here. Short, 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 short. And then, the stop wouldn't let it get to the other side. But, these are basically what the models are. These are the simplest models you can possibly imagine. So if you can imagine, okay, I get long here, and I'm just going to write it out probably until here. And these trend, the other part of these trend following systems, they have extremely low win rates. Between 28 and 45%, depending on how you do it. But it's almost impossible to imagine a giant dislocation of global markets where everything doesn't move. Like you remember crude oil went negative in the COVID? I was short crude oil. I was like, it was one of the most incredible things I've ever seen. I can't believe this is happening, and I can't believe I'm short.
Yeah, that's amazing.
Yeah, it was fucking amazing.
Good for you.
The stops are really wide, so so there's another problem with it. Like you don't keep all your money because to be able to stay in a trend, you have to have very, very wide stops. Not that I use stops anymore, but
yeah, okay. All right, so your win rates are low, but you're often going to catch large moves out of big dislocations in the markets.
And if you think about what happens in a big dislocation, correlations go to 1, right? Like that's like classic things. So everything trends. So because you're trading 40, 50, 100 markets, you could have 40, 50, 100 like balls to the wall trends. Like check out these. Let me show you what I'm in right now.
Yeah. So everything's gone down and then everything goes back up. And
let's see what I'm in today. So I'm in Ocean, HNT, UNFI, SNX, DYDX. Let's have a look at these shit coins.
This whole crypto thing.
It's terrible, terrible market. So, I'm long this, and I've been long it for ages. Ocean, HNT, never heard of it. Long this, UNFI. So you just mechanically, it's just the same chart. You're just mechanically long anything that starts going up. So if you get a big move that like a broad-based bull move or a giant big crash, unless it's a single day crash, like a 1987 crash, a trend following wouldn't do well. Like a crash, immediate bounce back. But anything that's that lasts a while, you're going to be in within 3 or 4 days.
Yeah, okay. Interesting. So it's funny because like, so during COVID, I mean, I'm not a trend follower, but during COVID, like obviously it just crashed, and initially I was like, wow, this is bad. And
Yeah,
then I was like, oh, this is kind of good. Like there's an opportunity here. And I just kept adding to the market like every day, just
oh, that's
small
amazing, dude.
parcel every day. And obviously did really well. Um, but in a sense, just I kind of knew at some point that that trend was, going to reverse, or sorry, the short trend was going to reverse and the market would go back up. And obviously it did. In hindsight, I probably could have done it a lot better and made a lot more money, but it was a learning experience.
It was
So
a horrifying time for me. My discretionary trading just went to shit during that. I
yeah,
didn't
yeah,
cover
yeah,
myself in glory there.
yeah, fair enough. All right, so speaking about sort of big moves and sort of big things that have happened, let's sort of talk sort of stories and that sort of thing. So, what's the sort of, just what's the best and worst investments that you've made? And I guess really the important thing, what did you learn from each of them?
So that's a good question. So the best investment I ever made, I went over to settle on a block of land in Bali right the day before the first Bali bomb went off, and I bought this block of land, and I paid a deposit, and blew up about a kilometer away from me, and I was like, oh, Bali's probably dead. Should I walk away from the deposit, or should I go through with it? And I went through with it, and that was the best investment I ever made. I bought a block of land for 280 grand and sold it like 4 years later for 3.2 million. It was like, holy shit, I
Yeah,
never
okay.
never had one like that. And the thing I learned from that was the investment that puckers your ass. The one that you're like, oh, I don't know if I want to do this. Because I had some really good crypto investments as well when everyone hated crypto in 2019.
Yep.
And it's the same theory. It's like when people really hate something, that's a good time to invest. And the investments that pucker your ass, the ones that you don't feel like are a slam dunk. And I had the opposite experience too. I bought some Noosa beachfront property in 2006, just before I went to jail. And yeah, I did my ass on that. I was like, and it felt great. It felt like I was already planning the compounding growth in my head, and I completely did my ass. Like it was very embarrassing. So the one, I guess what I've learned from that is the investments that feel comfortable to make, you probably got to think twice about. But the investments that are like, oh, it's probably worth the bet, but oh, there's something really shady about this. Like, oh, those are the ones that
Yeah,
work.
I think that's true though, because like even in the most recent like this big move in you know the S&P recently, and
Exactly, the one recently, it was amazing.
yeah, and when it was, I forget, can't remember exactly where it got to, but it was sort of right down at the bottom, and I was like feeling sorry for myself, and oh, what have I done? And bit of a decent drawdown, and I was just thought, oh look, I should be buying I should be buying down here, so I forced myself to buy some, and within a day, it was dumb luck, but within a day or two, the market turned. We've had this like amazing rally through all of November and basically made my year. Really think about it. So
Well, that's very courageous. Like you like, and I think one of the things we don't do as traders is pat ourselves on the back. Like we tend to depreciate and say that's luck, but there's actually not one bit of luck in there. Like that was your experience telling you that this feels a certain way, and when this feels a certain way, I have the felt experience that this is probably a time to buy, to hold your nose and buy. Like
yeah,
that's that's the definition of good trading, man. You should give yourself a attaboy for that.
thanks, mate. I appreciate it. Yeah, it scared the shit at the time, but yeah, in hindsight, it was good. All right, so what about, obviously this is sort of geared more to sort of retail type traders and people that are, not sort of sophisticated and experts in the market and that sort of thing. So someone that's sort of, in markets and stumbles across the show and trying to figure out sort of what everything's about. What advice would you give to someone that's just sort of starting out in markets and investing, and what's kind of the best place to start to sort of get up to speed and figure out what's going on?
So I would actually start with at the Robot James or robotjames.com. His stuff is probably the best introduction to what is like the fundamentals uh, of trading that I've ever seen anyway. But what I would personally do is have a very small account for active trading. You can get as much experience and knowledge out of a $10,000 play account, punting a few shares of this and a few shares of that, as you can tearing up your super fund. Like you can definitely, and most retail traders should be doing very passive things. You shouldn't be. You should be buy and hold or buy and hold adjacent, or a mix of different risk premium types. I mean, for me, my ultimate vision, not for the next 10 years, I'm trend plus nothing personally. But I'm a bit weird. But after
Why is
10,
that? Why is that?
I have a view that we're entering a low growth, low returns world, and I think the odds are that the equity risk premium looking forward is probably going to be lower than it has been over the last 10 years. So ordinarily, I would say 50-50 trend equities is pretty close. Like I know it's not right. Like you should have some bonds as well, but you know, ultimately probably a third bonds, a third stocks, a third trend is probably, you know, you could argue the semantics, but that's probably close.
Yeah, fair enough.
And if you want to get cute, like if you get a big crash, buy some equities, um, and rebalance quarterly, like you do, right? Like,
Yeah, I think so. I think you're right when you make the comment about sort of starting small. Um, you know, that that meme, you the fuck around and find out meme. You know, you sort of got to like you've sort of got to find what is your place in the market that makes sense to you. Like trend makes sense to you, and someone else might be a you know
well,
dive.
I was just lucky because you know I had all these people teaching me things that categorically weren't an edge. Like you're not finding an edge in time series patterns on a chart that hasn't been picked over and discovered by other people before and arbitraged away. You are just not. That's a fool's errand. If it doesn't matter how much you can work 100 hours a week looking for technical analysis chart patterns, which are just an artifact of momentum anyway. And you're not going to find anything real, so you waste your time. Like if you want to trade, you got to start with something that's an edge, which is buying equities, selling vol, carry, which is okay in crypto. It's hard in TradFi, and what's not hard in TradFi, and trend or momentum. Like you've got to start with something real, otherwise you can, you know, you could spend your whole life doing it, never make any money, and you would never know because like it would take you 30 years to get statistical significance to know if you, even if you made money, you would never know if you weren't just lucky, right? Like we never approach statistical significance on any of this stuff, right? Like, am I a good trader? I don't fucking know. Like how the fuck would I know? Like the evidence isn't there for me to say that. Feels like I kind of know some stuff, but like I don't know. I've underperformed the SPY over 14 years. Like rationally, I can't be that good, right?
Yeah, we'll know in 16 years, I guess.
Yeah. We'll know then, right? Like, yeah. So all in all, I would say that the sort of person who has what it takes to make it as an independent trader would almost certainly be successful at almost anything else they want to do.
Yeah, yeah, I think that's smart, and I've heard other people sort of say like, you know, in the COVID period when Twitter was really active and there was lots of people on Twitter and there were obviously lots of people trading because the market was going up and there was quite a few people talking about, you know, becoming a full-time trader and that sort of thing. And there was a few sort of older guys like Dude and a few others that were sort of saying like, yeah, that's fine. Like get into trading if you want to trade full time, but like keep a day job and do that
Keep your
sort of
day
thing.
job.
Yeah.
It's yeah. That would be my. I mean, I'm unemployable, right? But
Yeah.
I would say keep your day job would be probably top of the tree advice.
Yeah, and I think it just removes a lot of the angst and mental anguish. You know, if you're having a drawdown, you can sort of you've at least got something that's coming in to feed yourself and the family and that sort of thing, as opposed to putting all your eggs in one basket and being unlucky in timing and might be the beginning of a 4 year drawdown and you know, not a great place to be if you haven't got any other things to do. So
Exactly.
is there I guess, you know, we've covered heaps of ground appreciate it. It's actually been really interesting, to be honest. Um, is there anything else that you sort of wanted to say or share, or that's, you know,
Hmm.
like you feel like we've missed or anything?
I think it's been a pretty interesting call. I mean, I probably didn't do, I probably didn't cover like the mechanics of trend following stuff properly, but like there's plenty of places to get more information on that. Rob Carver's books are really good if you want a place to start. Um, Rob Carver's book and Andreas Klenov's book, Following the Trend, is a good introductory. Like and books, by the way, over paying for, never pay for a trading educator as someone who charges people to educate them about trading. Like you should never pay for someone like me to teach you how to trade. Everything is better in books. Everything.
Yeah, okay. Yeah, that's good. I've read a little bit of his stuff and I've enjoyed it. Um, yeah, maybe I'll take another look at it. So,
It's a bit mathy.
yeah, yeah, yeah. I always get lost in those sections.
Yeah, I had to get a fucking math tutor.
Yeah, fair enough. So look, thanks again for coming on the show. If people wanted to sort of find you or reach out, what's sort of the best way to do that on
I'm
Twitter
I'm
or?
I'm on Twitter, or if you got a specific question about like trading system stuff, always happy to help with that stuff. Scott at scottphillipstrading.com. Just shoot me an email. As long as it's a legit question, yeah, I'm happy to help anyone who's serious.
Yeah, cool. That's really good. I'll put a link up to your Twitter account and that sort of thing, obviously in the comments if people want to reach out.
Yes.
Look, thanks again, mate. It's been great to show. Really enjoyed the chat. We should do it again.
All right. Wish you every
Cool.
success with the channel. It's really cool, man. It's good to see.
Yeah, look, I got no idea where it's going, but we're just having fun at the moment, so we'll see what happens. Look, if anyone, look, hopefully everyone enjoyed the show. Again, like and subscribe if you get a chance, and we'll
Like and
see you next
subscribe,
time.
motherfuckers. Don't make me come and find you. Fucking trick. Yeah.
That's it. All right,
That's it.
peace. Thanks, guys.
See you guys.